Cool. Off you go, Kirsty.
Thank you. Thanks, James, and thanks, Michael. Hi to everybody. Really appreciate your time this morning. My name is Kirsty Muckle. I'm the Engagement Manager for Branches here at Engineering New Zealand. We really hope that you enjoy today's webinar. There's plenty of time for questions, and James and Michael will go through that at the end of the presentation. You probably have heard that we are recording this session, so if you miss anything, don't worry, I will send you a link to that recording, as well as a quick survey, as James and Michael would really appreciate your time to do that. Just a little bit about Lighthouse Financial Services. A couple of years ago, maybe a year and a half ago, they provided a few webinars for us during the first lockdown, and we received some great feedback from our members. And so last year they became a partner of Engineering New Zealand and do webinars throughout the year. So if you have any thoughts on what you would like to hear next, please get in touch with me. You'll receive my details obviously when I send you the recording. Lighthouse Financial have been around since 2014, and they help New Zealanders make better financial decisions. They are made up of accountants, mortgage advisors, and financial advisors. So I'm now going to pass over to James. So we really hope you enjoy today's webinar. Thank you.
Great. Thank you very much for the introduction, Kirsty. I will quickly share my presentation, and also, Kirsty, do not take this personally, but I'm going to kick you off as a withdraw you from being a host. All right, Michael, you should be able to see the screen.
Yeah, I can see that now.
Great, and then just got to kick Kirsty off one more time. Just she keeps getting demoted, it's horrible. All right, hello to everybody. My name is James Blair. I'm joined by my very capable co-host, Michael Vincent. Today is planning for retirement. We've run these sessions with probably 3,500 people over the last 12 to 18 months, where typically we'll do like a first home buyers one, a mid-career one, and a planning for retirement session. Today is all about talking about when you hit your golden years, however young or early, young or late that might be, making sure that you have peace of mind that you can live the lifestyle that you want. We're going to talk about planning for retirement, how to achieve financial freedom, things within your control, but also different ways you can invest your money. Planning for retirement's a little bit of a tricky one, and what I'm very keen to do with the people on this call is understand where people are in their stage of life. This kind of webinar is probably the one where we can go the most off track, because we might have people who are getting ready to retire tomorrow, people who are 10 years away from retirement, or people who are, say, 50 years away from retirement. That could be a 20-year-old, that would make sense. So we're going to ask some questions as we go. It's really important that we get some feedback along the way to make sure that we understand where you are at. Today's session, we're probably going to talk for about 40 minutes. We really, really encourage Q&A questions along the way. So you will see the Q&A function and the chat function. Please use the Q&A function for a question, just so we don't lose it. And then at the end, we will answer as many questions to your heart's desire to make sure that you get what you want out of this session. There'll also be the opportunity off the back of today to book a one-on-one session, either with Michael to talk about your mortgage needs or myself to talk about a financial plan. We also do a discount on financial plans for Engineering New Zealand members.
Cool. So we had a quick introduction as to who we are, Lighthouse, but thought we'd recap it again. So ultimately, what do? We help our customers grow their wealth over the long term. This is through making better financial decisions. If you signed up today looking for put all the money on cryptocurrency and it'll all be fixed in 10 minutes, you've come to the wrong place. We're all about making small incremental decisions over time that help our customers grow their wealth. And sort of leads them into a better position for retirement. We have a few different arms to the business. We've got accounting, mortgages and debt, which is my side of the business. We've got wealth, investments, insurance advice. We also do some property investment and consulting and some trusts as well.
Yeah. The other thing with these webinars as well is we try and have a bit of fun. Like, finances can be a little bit dull sometimes, so we try to enjoy ourselves during these webinars. So hopefully it's a little bit more enjoying as you kind of take some key points away.
Cool. So our disclaimer. So James and I are both financial advisors, but this isn't personalized financial advice. We're just talking in general terms here. We're going to ask, answer as many questions as we can at the end. There may come a point though we just have to tap out and say, you just need to book in a time with one of us to speak to us. But if you do want to discuss your personal situation, we're happy to book a time to sit down and run through that with you, but we can't get too personalized. And if it gets to the point where it's sort of, my husband earns this, I earn this, we've got this cost, how much can we borrow or something like that, we're just going to have to get you to book in and sit down and speak to one of us.
Yeah. And then if you've got somebody else that you work with.
Oh, James, I think you're on mute there, mate.
Oh, can you hear me?
Yep, I can hear you now.
Oh, the old air. Hello?
Yep, I can hear you now.
Oh, that's weird. Let me know if I'll probably notice myself if they drop out again. Is that pretty much what I was trying to say? Is there's no like sales pitch to go. Definitely come and talk to us if you want to. That's cool. If you're just here for some education, that's fine as well. So when it comes to planning for retirement, there's a few really important things. One is financial decisions and where you invest your money. Saying I want 10 investment properties, or I want X amount in the bank, or whatever it might be, is in our period not where we like to focus. Where we like to focus around what are you trying to achieve? What are your goals? Are you on track to achieve those goals? When will you achieve financial freedom? And what's going to make you happy? How do you want to spend your time? So when we're talking about planning for retirement, where to focus our energy, where to invest our money, the widget of where to invest, whether to pay off debt, grow your wealth through investment property, shares, whatever it might, KiwiSaver, whatever it might be, that is secondary to what are we trying to achieve, and then what are the right widgets to get there. So I'm having a bit of a problem with our polling questions. So you might, in the chat function, I would be very keen, just so we can get an understanding of who we're talking to today, if you can just pop in the chat, how far away are you from retirement? Are you less than 10 years? Are you 20 years away from retirement, 30 years away from retirement? Just so we can get an idea where everybody is at, and then we can kind of tailor it a little bit. Okay, so we've got some people who are pretty far away from retirement. We've got some who are quite close. Awesome. So I'm just having a look at, this is so much easier in a poll, Mike. So 30 years, 5 years, 20 years, 10 years, a real range, 2 to 4 years. So what we will do is, we want this to be as relevant to as many people as possible today. But obviously, when we're talking about the specifics around retirement, it might be not as familiar for some as others. But when we start talking about investment strategies, that will be beneficial to everybody.
Cool. So we'll start with some stats. So 46%, what is this one? 46% is the percentage of Kiwis that are unsure about their financial future or making a large financial decision. Now, this seems like a really big stat, but if we think about it on a logical basis, if school doesn't teach you about this, if your parents don't teach you about this sort of stuff, where are you meant to learn and get guidance about making the right financial decision? That's a really big piece of why we run these webinars. So 80%, that is the percentage of your income that you are going to need moving into retirement. And, we get a lot of people that say, I'm earning 100K per year, but as soon as I hit retirement, I'll be fine on 40. The stats say otherwise. Generally speaking, you're going to need about 80% of that to carry you through to retirement. You may not need that throughout your entire retirement, but, sort of at the start and at the front end, you'll definitely need that. James?
So $1 million is how much you need to retire if you are in a couple and want an income of $80,000 for the rest of your life. Now that's also including New Zealand Super, which we'll talk about in a second. If you are single and want an income of $80,000 for the rest of your life and you retire from age 65, you're looking at needing $1.2 million to retire. So these are some pretty big chunky numbers. Now, as Mike said, our philosophy around investing is slow, consistent steps over time, build wealth. Get rich slowly is one of my favorite sayings. For those that are closer to retirement and maybe have a little bit of work to do, there's no point in playing the hindsight game. There's no, woulda, shoulda, coulda. There's around what can I do over a period of time? And I promise you, there is like over a 5-year period, a lot you can do to improve your situation. If you've got 30 years, small, consistent steps can make a huge difference.
And then if you are less than 50 now, we do not anticipate that you are going to be receiving New Zealand Super moving into retirement. And it may not be that you receive none. It may just be that you receive some, or that you receive it at a later date, or that you only get it from 70, or it's means tested or something like that. But generally speaking, we're not relying on this if you're less than 50 years old, because we simply don't think that it's going to be at least in the same format it is now, or the same amount.
Yeah. And then for those that don't know, superannuation for a couple is about $30,000 after tax a year, and for an individual about $20,000. If you multiply that over a 25, 30-year retirement, that is a lot of cash that you need to make up for yourself. So it's important that you have a plan in place so you're not dependent on the government, that you're going to be okay by yourself. So today's agenda, we're going to kind of focus on these 4 quadrants, and then the 5th quadrant, which we're missing, is the Q&A. So we're going to answer as many questions as you want. For those that have joined us a little bit late, we're going to run through our content. We want you to pop questions in the Q&A function, and then we'll tackle lots of questions at the end. This is fundamentally how I think about, as a financial advisor who's been doing this for 10 years, this is fundamentally how I think about retirement. So setting goals, it's hard to know if you're on track if you don't know where you're going. Planning for retirement, a bit of the softer stuff that will be much more relevant for those that are a little bit closer to retirement. How much do you need in retirement is a big question nobody gives you an answer to. We'll give you some answers. And where should you invest your money? So as I said before, the starting point is setting goals. And one thing is, I might mention this in terms of the stats up front, 46% of Kiwis are worried about their financial situation. Nearly half of the bloody country is worried about their finances. Now, that stat is pretty scary. And I think part of it is probably around our relationship with debt. And also the thing that it's much more enjoyable to spend money now than to save for this future. Now, it is much easier to save for the future and plan if you have goals that you have set and you know whether you're on track or you're not on track. So common goals that we help set with our clients might be, you want a passive income through retirement. You want to maintain your current lifestyle as long as possible in retirement. You want peace of mind about the future. So you might love your job as an engineer. You might go, what I'm doing, building bridges, doing other engineering things, which I have no idea about. You only get one out, Mike. That was horrible. You're really passionate about your job and you don't plan to retire early. It might not be important to you, but financial freedom might be important to you. So the idea that if you did lose your job or you couldn't work, that you would be okay. Traveling, Mike has a very expensive lifestyle. In retirement, he wants to spend 6 months in the south of France. But if you're more like me and happy hanging out in a shack in the bush, you might need a lot less come your retirement. Simplifying goals is financial positions, another one. Not being forced to downsize your home, and then obviously helping kids and grandkids is a pretty typical goal that we see. So that's a list of goals we see all the time, but it's going to be completely dependent on your situation, your values, and what's important to you. So if you are 30 at the moment, you might not know when you want to retire. You might not have had this family yet. But taking steps now, small steps now, will allow you to have options as you get closer to these goals. If you are near the end of your working life and thinking about retirement, you probably have a lot more certainty. So when it comes to setting goals, and this is what we can help you do, or you can try and do this by yourself, is I break setting financial goals into 3 steps. One is kind of the big overarching goal. It might be, I want financial freedom, I want passive income, I want to retire before 65, whatever it might be. I want to help my kids into the first home, whatever it might be you're trying to achieve. Now that's nice, and it's good to set that high level goal and have a little bit of a think. But obviously the next step down from that is getting around the specifics. So what is your cost of living at the moment? Will that cost of living look the same in retirement? How much do you plan to spend on travel? Will you stay in your current home? What age would you like to retire? And starting to put some metrics around, this is the goal you're trying to achieve. So a specific might be, I want an income of $100,000 a year from age 55, or we'll say 55 to, shoot for the stars, 55, and I want to help both of my kids into their first home. That might be a goal that you're working towards. So we've gone from high level to a lot more specific. And then you need to work it all the way down to, what do you need to do today to make steps towards that goal? And then we can help you work out, or you can, there's some online tools that you can work out by yourself, going, am I on track to achieve this or not? If it's not, then you need to know, and you either need to choose to save or invest more now, or take a bit more risk, or you delay your goals. So setting goals is, before you start thinking about all the fun investments and starting your own business and side hustles and building houses and whatever it might be, you need to think about, where do I want my money to get me? So that's a little bit around goal setting. So where are we? Where are we now? Where do we want to get to? How are we going to get there? You should all be writing down, hopefully, a couple of things around what is important to you, the specifics around how to achieve them. Once you've got those goals, there's a lot of other stuff that happens around retirement. It's not just you retire, you get an income for the rest of your life. So here are some tips that we give for those that are heading into retirement. And if you're still quite far away from retirement, probably some things you can take. Mike, do you want to talk us through these?
Yeah, so look, I guess the first one here is the one that everyone puts off and ignores, and that can lead to a bit of trouble when things go wrong. And a lot of, actually, to be honest, a lot of people ignore a lot of these things. But, having an up-to-date will is actually really important. Getting things stuck in probate after if something goes wrong can be really time-consuming and costly for the family when you're trying to look at how an estate is divided. And as you're later in life and moving through to retirement, it's important to make sure that these wills are in place and that they're actually up to date and they reflect the way that you would want your assets to be divided. It's something that a lot of people put off, but needs to be addressed. Not stretching too far to help your kids. We give this advice to a lot of our customers, and it's always a difficult one. It's that balancing act, right? Of how much do you want to help your kids? And usually that's as much as you can, but we just need to think about the long-term impact of that. And, what is that going to mean for you guys? You earned the money, you should enjoy it. So it's important to just keep it balanced when you are looking at that. Putting a power of attorney in place. So in the instance that you can't make decisions for yourself, someone you trust can make those decisions for you. And as you're moving on later in life, this is really important. And having an enduring power of attorney in place is a really sort of, it can make that process a lot smoother when things start to go wrong, or if you can't make those decisions for yourself, especially around your finances and your banking and these sorts of things. Important to get this set up early. Health insurance policies and life insurance policies. Look, this is around the time when a lot of people start to cancel those health insurance policies. They get too expensive. This is actually the time when you're going to start claiming on it. So it's important to just think about it. Think, are there other levers you can pull to make sure that these are still in place if you do need them? And with the life insurance, once again, this is also something where people sort of say, oh, look, maybe I don't need this anymore, or look at canceling it. perhaps, you should speak to an advisor or someone like that, just to make sure that, if you don't just cancel it, but actually you think about, are there other ways that we can reduce the cost of this? Maybe you need less income protection, but maybe more life protection or something like that, just to balance out that cost a little bit. And then the structure of your assets. So this is important on a few fronts. First of all, if you're looking at it on an investment front, moving into retirement, you do want to start potentially simplifying things and making sure that things are easier to manage, but also the structure and the ownership of your assets. So, are things in a trust? What does that trust look like? Is it a family trust? Is it going to make things easier to pass on to the kids if you want to leave a legacy and that sort of thing? So important to look at the structure of your investments, make sure they're simplified, they're working for you, but also physically, what is the structure of how your assets are owned, like investment properties or houses and these sorts of things.
Awesome. Okay. Now, before Mike gets into his favorite thing of all time, Mike, have worked out our poll questions. They are working. So I've got 2 poll questions for everybody, just to give us a little bit of a flavor of where everybody is at. The first one is, are you on track to retire? So the questions are yes, not sure, or no, I'm not on track to retire. Everybody's filling that out. Looks like a pretty even split, Mike. Some people are on track. So I'll end it there. So we've got, in terms of everybody on the call, I think we've got about 70 people on the call, that we've got about 37% of you are on track. Great, well done. 42% are not sure and 21% are not on track. The other question I want to quickly ask you as well is, how confident do you feel about your financial decisions? So once again, completely anonymous. Nobody has any idea who's filling these out. From not confident, could do better, doing pretty well. And I want somebody to tell me they're Warren Buffett.
Yes, we got someone.
Hey, there we go. Okay, I think one really important thing with these webinars as well is everybody's in a different stage with their financial literacy and decisions, and some might go, this is too complicated, others might go, it's too basic. So we'll try and find a good spot in the middle, just to give you an idea of where everybody is at. So about 10% are not confident, about half could do better, 40% are doing pretty well, and there's one person who should be running this webinar instead of us, Mike.
Yeah.
So
do you have, just a quick one, James, do you have the question we asked at the start around how far away people are from retirement? Do you have that set up as a poll question?
No, I don't.
Okay, that's all good.
Yeah. So this point here comes back to a bit of goal setting, is could you retire now? Are you in a position where you could go, hey, that paycheck that comes in every fortnight, that's great, but I'm all good? Or are you somebody who has to work? You need that paycheck to come each fortnight, or do you work because you love what you do? Now, this is like whether early retirement is important to you or not. This is something that I recommend everyone strives towards, is getting to a position that you don't have to work. You work because you love what you do. And it is crazy what happens in these situations. People's outlooks on life become much different. One or two things usually happens. Either people fall more in love with their job, they appreciate the things they're doing and the people they're doing with it, or they go, hey, get stuffed, I'm going to go and do something completely different.
So the sprint, when James said before Mike talks about his favorite thing, this is one of my favorite things to talk about. It is so highly underrated and people just don't think about this from a numbers perspective. And what the sprint is it's that period between paying off your mortgage, you're still working, and you haven't retired yet. This is absolute gold. During this time, you can save as much as you can put it in in an investment that gives you a solid return, and you can really build some capital and some assets that will provide you with that income going into retirement. And I cannot stress how good this period is. So we've got an example here of just what we can achieve over this period. And quite often, when we give examples, people will say to us, like, oh, this doesn't apply to my situation perfectly, or I'm not in that situation. And you can pull these numbers back and dial them in to sort of meet your situation a little bit. But I'll run through the example and we'll chat about it a little bit. So let's say you paid off your mortgage at 50, your mortgage repayments were 2,000 a fortnight, your only asset is your house, so nothing else. If you save those mortgage repayments until you're 65 and put them into a managed fund or an investment that gives you a 4% real return, which is not too unachievable, you're going to have 2 million by age 65 in assets, and this will be able to provide you with 120,000 of income for the rest of your life. So that gives you that's a really basic sprint. That's not too complex. All we're doing is taking the mortgage repayments, putting them in a managed fund that's giving you a consistent return, and it just shows you over that sort of 15-year period how much you can build up and what that can give you moving into retirement for the rest of your life. And I think that's, a really basic but good example of this. If you put a plan in place, and look at the numbers, what you can achieve.
Yeah. And if you said, your mortgage repayments are 2,000 a fortnight, that's still $1 million. But one of the things hopefully this emphasizes, and we'll get into different asset classes and ways to invest your money in a second, but keeping it simple. Engineers, very smart group. Sometimes and like lots of professions and people can tend to overcomplicate things. I would say trying to keep it really, really simple, back of the envelope in your investment strategy, so you know what's going on. This is a perfect example of, and not kind of our standard approach because it's a little bit too simple, but clearing the debt, regularly contributing into a managed fund, drawing the income in retirement. So how much do you need in retirement? So we talked about the goal setting piece before. It depends on a lot of different variables, but it depends on when will you retire, how much you plan to spend at the moment versus how much you plan to spend in retirement. Sometimes we talk to people and they go, hey, James, I'm spending 100 grand a year at the moment, but don't worry, I'm going to spend $50,000 a year in retirement. And it's like, well, how does that work? What are you going to give up? Because surely that's not the kind of lifestyle you want. Otherwise, you'd give up your current lifestyle now. Will you travel? How often will you travel? Will you downsize your home? Can be a big one. This is becoming a bit more tricky for two reasons. One is a lot of Jaffas used to sell up their house and move into the regions, but unfortunately the regions have really moved in terms of house prices. The other thing we see quite a bit is people selling their family home and moving into like an apartment, but new apartments are pretty bloody expensive. So you don't necessarily get that cash you want when you retire. And the other question is leaving a legacy important to you? If the answer is yes, you're obviously going to need more money to retire. So these are some of the variables that we can expect heading into to try and decipher what number is right for you to achieve. It'll also depend on, like, if you have an investment property, then that might be providing you with a passive income. That means you need less of a lump sum potentially. So we'll give you some ideas of some numbers to work towards, but once again, completely dependent on your situation. So this is a couple who is receiving New Zealand Super and retires at 65. So the pink number up the top is the amount you need as a lump sum. The blue number down the bottom is the annual income. So if you only want an income of $40,000 a year and you're receiving New Zealand Super, that's probably 200 grand. As I said right at the start, $1 million lump sum if you want income of 80K, all the way to 1.8 million if you want income of $120,000 a year. Now, if you are under 50, and we're assuming you're not receiving New Zealand Super, for the same pink number, you can deduct $30,000 off, and that's the income you would receive. So $1 million would get you an income of $50,000 a year in retirement, for example. Now, there's a lot of single people out there. We can't forget about all of you. Unfortunately, everything's just a little bit harder when you are single. You're paying for a full household of costs, on one income and you receive less New Zealand super. So the numbers change a little bit. If you want an income of $40,000 a year, 20,000 New Zealand super, 20,000 from your investments, you need 400 grand all up. In the middle, instead of 1 million, you need 1.2 million, and then you need $2 million of assets for an income of $120,000 for the rest of your life from 65 to 90. Now that's, so far we've spoken about setting goals and the importance of setting goals. Mike's run through some tips to make sure you're planning for retirement. We've then spoken about the sprint, how much money you need in retirement. We're now going to dive into the meat around investment options. We'll probably do this for about 15 minutes, and then we will start answering some questions at the end. So make sure that you're popping things into the Q&A function.
Yeah, so with this piece, a lot of what we talk about here really depends on, how far away you are from retirement. And I saw in the when we put that in the chat for the question that there are some people who are significantly further away from retirement, at which point we probably tailor the discussion a little bit more towards investment property. So I'll have a chat about investment property in the middle of this, because that can be a really good tool to set you up for retirement. And we'll talk about that and then what that means holding property through to retirement as well.
Great. There's just been one really good question here, which I will answer. New Zealand Super and KiwiSaver are different, right? Correct. So New Zealand superannuation is kind of the benefit you get paid from 65 by the government. So that's $30,000 a year. KiwiSaver is an investment that you're regularly contributing to, and then you have a balance come 65. So investment strategies are really important when we're thinking about retirement. And the main reason for that is when you've got this thing that comes in each fortnight, each month, which is your salary, right? You've got your income tap turned on from your employer. It's kind of filling up the bucket, allowing you to do all the things you need to do. That income tap is going to get turned dry in retirement though, and you need to make sure you can turn on your passive income tap. And whether it's your managed funds, your KiwiSaver, an investment property, maybe you have a business, whatever it might be, that you can pay yourself your fortnightly salary from your own assets, opposed to somebody else paying it for you in exchange for your time, for money. So the question is, well, you're ready to retire or you're ready to think about retirement, but where do you invest your money? And the problem with where we are, I'm going to sound old here, Mike, but like with where the world is at the moment with the internet, is there is no lack of information out there. You can find anything to support any argument in the world, which we won't go down that rabbit hole. But it then becomes, well, I mean, my friends told me they're investing in X. Should I put money in there? They're telling me they're doing a really good job. Here are some pretty common things we think about: cash, shares, managed funds, rental properties. Where should we invest our money? Now, this table chart in here, you might go, my goodness, what is going on here? This graph is showing from 2006 to 2020, the top performing asset class in each year is up the top, and the worst performing asset class is down the bottom. So say in 2006, REIT is Real Estate Investment Trust. So you're pretty happy in property in 2006. You're pretty sad in property in 2007 and 2008, and then you're pretty happy again. One thing that I just want to emphasize here, though, is it's impossible to pick the winners. If you think you are smart enough to pick the winners of asset classes, good luck. You definitely don't need us. It's just trying to pick the right asset class. So whether it's property, small cap shares, large cap shares, international shares, bonds, I can keep going. It's hard enough by itself, but then you need to pick, well, which country in that asset class is going to perform the best, and then also which industry is going to perform the best within each of those. So lesson number one around investing, it is about time in the market, not trying to time the market. Time in the market, not timing the market. This is what trying to time the market looks like. So this is the S&P 500 performance each quarter rolling over the last 30 years. So it looks like you've gone to the hospital and things aren't looking too good. You're a little bit all over the place. You can see some quarters are performing, 10%. Other quarters it's dropping 10 to 15%. The other thing with this correlation, so the S&P 500 for those, this isn't the S&P, this is actually a 50-50 investment portfolio. So it's like a balanced KiwiSaver is the best way to think of it. So a balanced KiwiSaver, if you look at that, it doesn't even say like, if you've had, some people will not invest money because the last year's been really good. But our stats show us that that doesn't necessarily mean if we've had a good or a bad year, it's necessarily going to be a good or a bad year for the next 12 months. So when you are investing, you should be thinking about how long do I have to invest? How comfortable am I with fluctuations up and down? How will this investment help me achieve my goals? And if you can keep a long-term view of your capital, this is the top 500 companies in the US over a rolling 30-year average. So the graph before was each quarter and it bouncing up and down. This is very consistent. This is staying between a 8% return and a 12% return over 30-year periods. So graph before showing that trying to time the market, work out what's going to happen next is impossible. But if you can stay consistently in a strategy for a long period of time, either if you're in retirement and you don't need to take the lump sum, you're just drawing out a regular income, or you've got a lot of time left in the game and you just need to just regularly contribute, over the long term, things are going to be fine. It's what happens in the interim that can cause a bit of chaos. Now, when we're thinking about investments, we also need to be thinking about inflation. So to give you an idea, in 20 years' time, $100 of groceries today will cost you $150 in 20 years' time. So 50% increase in prices over that time. Now, you might be thinking with the price of cherry tomatoes in the last few months going, feels like 50% rise already, James. But when we think about our returns on investments in our investments, we need to be making sure as a minimum we're outperforming inflation. Otherwise, our money is going backwards. Jump past that slide. So if we're thinking about, well, we can't pick the market, we've got to think about having a diversified approach and staying in the market for a long period of time. These are the 4 quadrants of where you can invest. Cash and bonds are very low risk investments. They're not going to derive too much of a return. But if you're not comfortable with big ups and downs, you've probably got more of your investment sitting in the left-hand side. Property, whether commercial or residential, plus shares. Now, this might be international shares, Australasian shares, and then any good portfolio should have exposure to at least hundreds of companies, if not thousands, that you've got good diversification. There will be periods with these kinds of investments where it drops in value and it doesn't perform, but diversification, time in the market, you'll end up in a much better position over the long term.
So I've seen quite high returns on some bonds though. So, is that always a low risk investment or?
Very good question, Michael. No, there's a stuff called junk bonds out there. So junk bonds are where a company needs to raise capital, but is in pretty ordinary shape. So they will offer you a higher return, but if they fall over, they're more likely to fall over. Their credit rating is quite poor. So you need to be looking at, just like a share as well, you can invest in quality shares or crappy shares. You can invest in quality property or crappy property. Same goes for bonds as well.
Yeah, and I think just one more question before you move on to this slide. So looking at those 4 quadrants, property seems fairly straightforward to invest in. I buy a house. Cash seems fairly straightforward to invest in. I keep my money in cash or a term deposit. Bonds and shares, yes, I can go and directly buy shares. Would you advise that? And can I directly go buy bonds? And would you advise that?
So one thing you need to be thinking about is when investing, and a lot of our clients sit in this bucket and how they ended up coming to us, is How involved do you want to be in your investment strategy? How much time do you want to spend? You might really enjoy it, but you might not have the time. You might have the time, but not really enjoy it. So if you're investing directly in shares, you need to be spending substantial amounts of time understanding that company and also what's happening at a macro level. If you're buying bonds directly, it's the same thing to an extent, although you could probably sit and hold on some quality bonds a lot easier. If you want to outsource it, which is obviously what we do, where we build investment strategies, we can help go, here's what all our research says, here is our recommendations around a full portfolio, and this is the fee we charge off the back of it.
Yep.
Now, for those that have money in the bank, for conservative investors, it's important to know that it is not risk-free. Now, I'm not saying that, somebody's going to steal your money. I'm talking about that if you've got a term deposit with a 1.2% interest rate.
It's been a while since I've seen a 1.2% interest rate on a term deposit, but yeah.
Yeah. Take off the tax, you get around 0.8%. But once you take off inflation, your money going, the cost of living going up each year, cash is the only investment which over the long term will go backwards. So having cash in the bank is not ideal. Now, if you have short-term expenses, i.e. you want to buy a house, you can do some renovations, you want to buy a car, planning for a wedding, whatever it might be, cash is fine for those short-term goals. But if you've got longer-term goals, it is the only investment where your cash will go backwards over the long term. Now, for those term deposit investors, you might be there because you've been burnt in the past. It might be the 87 stock crash, 9/11, GFC, or COVID, which COVID for the share market was one of the quickest recessions of all time in terms of from the share market perspective. Mm-hmm. These kind of events will happen every 5 to 7 years. 5 to 7 years, I guarantee it. There will be the next COVID, the next GFC, the next tech bubble burst. You need to expect those things to happen in the future. That's why a diversified strategy is so important. You've got your eggs spread across lots of different baskets. Things will go up and down. You understand how much they can increase and decrease in value, but you feel comfortable with that journey. So if you can't sleep at night with any volatility, then maybe term deposits are the right place to be. But is the share market going to go to zero? No, it's not. Otherwise, nobody's got jobs. Our houses aren't worth anything. We might as well go hide under a rock. If you can kind of get your learning and education to that point where you're comfortable with a certain degree of volatility, even with like 80% of your investment being in cash and bonds, at least you've got something growing for you, something trying to outperform inflation over time. I'm conscious of time, but a lot of people might be thinking, well, what is a bond? Bonds are a little bit out of fashion at the moment because interest rates are so low. But fundamentally, a bond is, say Michael runs a business and he goes, hey, I'd like $50 million. Nobody give Mike $50 million first off, but I have $50 million. I'd like $50 million to upgrade my IT systems. And in exchange for that, I'll pay you 3% each year. And then I'll pay you your money back at the end of 5 years. That's what a bond is. It's different from a share because if Mike had a company or invested money in Mike's company, a share is a dependency on the performance of the company. So it will go up and down in value depending on what Mike does and the perception of what Mike does each day. A bond is a set agreement, which is essentially lower risk because it's considered debt opposed to like a equity investment.
So the Kiwi option, property, and we found the picture of the most Kiwi looking batch we could find.
Pretty nice batch.
Yeah, so look, Kiwis are obsessed with property. Everyone knows that. We hear about it on the news every night, how unaffordable houses are, all these sorts of things. And, it is a real focus for investors, and it can be a great option, but it can also be a not so great option when you're moving through to retirement. I'm going to spend a little bit more time here talking about property investment, just because we do have some people who are further away from retirement on the call. And then I'll move into what you should potentially look at doing with that those assets as you're moving into retirement. So the real advantage of investing in property is the leverage that you can gain using the bank's money. If I look at, say, a new build buying off plans investment property, for example, I might have to put a 10% deposit down. Let's say it's a $1 million new build. So I put $100,000 down. I'm not drawing down on any other loan or mortgage until that house is built in 12 months. And I've likely already made probably 100 grand on that house. So already you can see the power of the leverage. Even though I've only put 100 grand in, I've doubled my investment in 12 months. I then draw the mortgage down on that. So, the $900,000 mortgage. And from there on out, I've put in 100,000. The bank has put in 900,000, and we are getting a 5, 10, recently a 20% return on this investment, on a per annum basis. So that is the power of property as an investment vehicle, is that leverage and that ability to leverage up really quickly and get those higher returns. So super attractive. The other thing there is, you can get if you structure it correctly, you can get the investment so that it's at a cash neutral or slightly cash negative position, whereby you're not having to tip a whole lot of money in just to maintain it. Those make it a really attractive investment. And the other thing is, if the world falls down and you've still got someone renting out the property, it's going to cover itself, right? So that's why Kiwis love it. And it's super popular and really good. Moving into retirement, though, this may not be the best option, because if you think about it, I've got all of my capital tied up in this house, but I can't sell a bedroom to go on holiday. So it may be that as you move into retirement, you need to sort of adjust the way that you're either investing in property or sell down these assets and potentially shift them to a more liquid fund. Like I said, you can't sell a bedroom to go on holiday, but you can draw some funds out of your investment portfolio to go and do that. And people end up being asset rich and cash poor, which can be a slightly strange thing to think about. But, if I've got this $2 million house sitting there, but I'm only getting, $800 a week rent off it, is that a good return? And is that going to give me the lifestyle I want when I move into retirement? There are other ways that you can invest in property outside of directly buying, a house. You can go into a syndicated property fund. I don't usually recommend that so much, just because, it gives you less control. It will give you a little bit more diversification. It'll probably give you some exposure to commercial property. Now, investing directly in commercial property is a little bit more tricky than just buying a rental property, getting some tenants in and getting the thing done. There is substantially more to consider and substantially more risk with a commercial property. So if you're going to do that, you really need to do your homework. You really need to speak to a broker about that, or someone who can give you some advice on investing in that commercial property. So generally speaking, though, residential property, great to leverage upwards over time. If you are thinking about doing that, have a chat to a broker or a banker or something like that. You can use existing equity in your property, so you don't have to put any cash down to sort of get you there. But yeah, great to build over time. But like I said, once you start to move into retirement, potentially not the best asset to have. This can be because of the return. The lifestyle you can live off $800 a week isn't as great as potentially the lifestyle you can live off the returns from a managed fund and pulling some of your capital out. You can only live off that income assuming that you don't have a mortgage. So let's say you leverage up and get 3 or 4 investment properties and they're all, maxed out, and you've got, 90% lending on each one. You're still going to have to pay the interest cost on those mortgages. And that's going to get harder and harder to do as you move through retirement. You can't erode your asset over time. Like I said, you can't sell a bedroom. You can only sell the whole house. And they're pretty high transaction costs for that, if you think about the time and how much you have to pay a real estate agent. So a little bit of a disadvantage there. and the lack of diversification. So having all your eggs in one basket, and James has touched on this throughout the whole webinar, but having all of your eggs in one basket is never going to be a good thing. And having all of your eggs in the property basket can present some real risks as well. If you just look at the recent changes that the government has implemented around the tax structure of properties or the LVR, how much you can borrow against properties, you can, by having all of your eggs in that basket, you can really see that you might come unstuck, even though you've got a good plan, without some diversification to spread that risk. And then the pain of tenants or, property manager. I know, James, you're loving your tenants at the moment. So that can be another sort of, pain is, how much admin do you want to put into it, and what does that look like as you're going into retirement? So an investment property versus a managed fund. Now, despite what I've just said for the last 5 minutes, pretty heavily weighted towards investment properties, especially as a mortgage broker. The advantages, you can leverage up. I ran through this before. You can put 100,000 down, you can double that in 12 months, and then you draw a mortgage down and you keep using that leverage to grow your returns. They have strong historical returns. So, pretty consistently, the market has trended in one direction. It may fluctuate over the short to medium term, but on the whole, it trends in one direction. It's familiar. Everyone knows what a house is. You can drive and see the house if you want. You can't drive and see the share of a company or something like that. So it's a little bit more familiar and a lot more comfortable with people. And it can provide you with that weekly income. Like I said, though, that may not be best going into retirement. And you also have the ability to add value. So you can get a house, do it up, make it your own, once again, exponentially increase the value, which can give you a really good return. The other real advantage of investment property is if you've got equity in your existing house, you may not need to put any cash down to get another one. You can 100% finance your next investment property if you have enough equity. So there's a lot of advantages there to investment property. It's just going to be whether or not that's right for when you move into retirement.
Yeah. And I think a slightly tricky thing is we're talking to two different audiences here, right? We've got an audience where you might be 20, 30 years away from retirement. And if that was the case, and say you've got a home with a bit of equity, investment property, it's actually not the returns have been really good. It's not the return, it's the ability to borrow money and turn zero savings into an asset, which $1 million that increases at 5% per annum over the long term, you're making 50 grand a year on average over the long term. If you are someone who is close to retirement though, and say you've just got, you're not in a position, obviously if you could have both, that would be great. But if you had to choose between investment property and a managed fund in retirement, I would 100% recommend managed funds, although we haven't spoken about your personal situation, T's and C's apply. The first reason is diversification. Fundamentally, property in New Zealand is based off a few fundamentals, which the government can tinker with, which we've seen recently. A managed fund's diversified and spread across lots of different industries and countries and asset classes. One of the big advantages to managed funds in retirement, if you've got the ability to erode your capital over time. So as Mike said, you can't slowly, reverse mortgages are sacrilege when it comes to Lighthouse. It's very hard to erode a house over time. With a managed fund, you could start with $1 million, spend the return in capital, and get down to 200,000 by 90 and still have the value of your home. You've got liquidity. I get phone calls all the time going, hey, we need a lump sum for whatever. You've got different levels of risks, and you've got that history over decades of strong historical outcomes. We're just about to wrap up in a couple of minutes. Make sure, I can see some questions coming through. Make sure to pop them in the Q&A function. We will stay past 11 and keep answering questions. Of course, if you have to run, no dramas at all. We'll also send out the recording. So when it comes to investing into the share market, there's three kind of main ways you can do it. Direct investing with like a Hatch, Sharesies, or an InvestNow. Now, if you know what you're doing, that's great. You can save money on fees, but there's risk to this approach if you are just blindly guessing. The market's become a lot more available, but there's risk associated when people don't know what they're doing. Active investing is where maybe you're paying somebody a higher fee and expect a better performance. Now, that is a little bit historically quite difficult to do, to outperform the market with a higher fee. So once again, need to be a bit careful. Passive investing is a good option, like Simplicity and Kernel, where you're just sticking the money in the market and looking to outperform the market, or perform at whatever the market has done over a long period of time. Now at Lighthouse, we probably do a combination of passive and active investing. So at our core, we focus on passive, but then we add a few active managers where we think there's a bit of a benefit of an additional return. Now you can manage all this yourself, manage your budget, find the right investment property, invest money where you see fit, work out a strategy. What we do is we help people know they're on track. Our advice, yes, will help people deliver returns, but our purpose is giving people peace of mind and linking the right investment to their goals and making sure that we're getting where we need to get to.
So key points from today: have a plan. Make sure you know where you want to go. James talked about a lot at the start around setting those goals, taking those steps towards the goals. Start making them early, so do them now. Those small incremental changes over time can lead to a really big difference down the track. So get onto that now. Think about what you want in retirement though. Think about the lifestyle you want to live, how much you're going to need, get those numbers sorted and then work backwards from there. And, make the most out of the sprint. It's absolute gold. I can't stress how much that sort of time period can help you when you're moving through to retirement. And if you're thinking, I put my head in the sand, I haven't done anything, I can't achieve where I want to be, doing something's better than nothing. And just, really sort of getting onto it as soon as possible is what we'd always recommend there. Consider your retirement investment options. I made the case for investment property being really good moving up to retirement, but perhaps not so good moving into retirement. James was talking about managed funds versus those investment properties. So just consider that mix of investment options and then diversification. Make sure you have a diversified strategy. I talked about it in investment properties. James talked about it when he was looking at the other investment options, but it is really important to have a diverse sort of basket of investments.
Okay, and so we're about to do the Q&A, but quick plug for us. So we will send a survey out at the end of today. If everybody could please fill out the survey to let us know how you found today, how to make future sessions better, that would be great. Also chuck in there what you'd like us to talk about in the future. We do these webinars every couple of months with Engineering New Zealand, so we want to make sure we're adding value. If you would like to have a chat with myself to talk about a financial plan, we will send links out afterwards. But for those who go, hey, I need some structure, I want to achieve my goals, there's a link to my calendar to book a free initial chat where we can talk about your situation, maybe some things you can improve and next steps from there. If you want to have a chat with Michael to talk about your mortgage needs, maybe you haven't spoken to a mortgage broker, maybe you need to review things, here is the link to Michael's and actually the whole mortgage team's calendar. So with both of our teams that we've got a really capable bunch of mortgage brokers and financial advisors who can help you achieve your goals.
Yeah, so that link will take you through to our mortgage team. Look, all of the guys are equal, if not better than I am. So they'll be able to help you with investment properties or structuring your mortgage and that sort of stuff as well.
Great. Okay. And then if you thought, hey, these guys are a bit of fun to listen to, we've also got a weekly podcast called Checks and Balances. An episode is dropping today around should you buy property with siblings? Should you do joint ventures around investment property? And then we've also got a weekly series called Money Bites where we break down money and jargon. So we will do some Q&A, Mike. I think we've got things going on both the chat and we might quickly do the ones in the chat. Any future questions that you're writing down, if you can please do that in the Q&A. First question is, does the income number take into account the continual return on the investment? So all of the retirement numbers that I was talking about was taking into account a return of, I think I did 2 or 3% net after tax and fees. And because in retirement, you're more conservative, you want to take less risk. But then the idea is you're eroding your capital over time. So you're spending the return plus slowly eating away at your capital. I am assuming that the income for 120,000 in retirement is total for the couple, not 120,000 each. Correct, it was for the couple. On top of maybe this one for you, Mike, on top of the minimum mortgage repayments, how much do you recommend to cover for maintenance, insurance, and not being tenanted? What about the risk of a big repair? Good question.
Yeah, cool. So we usually dial in 2 weeks of the year not being tenanted in terms of looking at the what does that look like from a cost basis. We just take that out of the rental return. In terms of maintenance and that sort of thing, that's really going to depend on the type of property, and this also sort of factors into the big repair as well. So at the moment, new builds are a much more attractive investment option for property if you're not going to add value, because everything's brand new. It's still going to be under warranty pretty much. There's less land, so there's less maintenance costs of lawns and that sort of stuff. So that can be an option there if you're concerned about that. How much do you add on? Yeah, it's really going to depend on the property. You're probably adding at least $1,500 per year, just in terms of small things that are going to pop up and that sort of stuff. What is the risk of a big repair? How much should you budget for that? Depends on the house. If you buy a new build, you're probably not going to have to do that at all.
Yeah, when I'm doing projections around investment property, I think about I do like a 6K amount, which covers accountant, insurance rates, some maintenance, plus a 8.5% property manager fee, which is taking out the rent and assuming it'll be vacant 3 weeks a year.
Yep.
What's considered to be a high fee on a managed fund, i.e. over 1%? Good question. It is one where it depends. If you're investing in a passive investment approach where you're not having people on the tools investing the money, 1% is ridiculous. You should never pay that. If you're paying for maybe an active manager who's delivered a really good return after fees, and maybe you're getting some advice for lower risk funds, 1.2% can be reasonable. 1.4 or 1.5% can be reasonable, but it also always depends what are you investing into. Apart from low interest rates currently on bonds, what other problems do they face? Yep, interest rates are low on bonds at the moment. The other, which is kind of the same thing, but I'll say it anyway, the other real risk around bonds at the moment is if interest rates shoot quickly going forward. So if you've got a 2% bond and interest rates shoot to 4%, that 2% bond is going to go backwards until it hits its point of maturity. So that means your bond portfolio is going to drop in value. So that's one of the real risks around bonds at the moment. The other thing is probably always thinking about quality in your bond portfolio as well. Mike, it's the same question?
Same question, yeah.
Okay, cool.
Same question.
So this is from Elizabeth. Is a managed fund such as KiwiSaver a good investment over time? The employee and the employer contributions are so low compared to Australia. I know, Elizabeth, it's crazy. So in Australia, you have to do, I think it's 9% contribution, and then it's moving to 12% over a period of time. We are woefully underprepared for retirement in this country, which is one of the reasons why I love doing these webinars. I wouldn't be contributing, depends on your situation, standard disclaimer, but I wouldn't be contributing more than the minimum to KiwiSaver, because you can invest in other things which are liquid and you can have access to your capital, depending on if you're good at not accessing your money or not. KiwiSaver is a great investment. The returns over the last 5-10 years, you can't argue with. On more growth funds, you're talking 7, 8, nearly double digits. Shorter, lower risk funds are still doing 5s and 6s. So a great return on your capital over time, but KiwiSaver is not enough to be prepared for retirement. When you reach 65, is it a good idea to keep funds in KiwiSaver and take a regular income or pull out all of the funds? Another great question there from Stephen. So Stephen, one of the real benefits of KiwiSaver is the fees are quite low. So I would be thinking that for a lot of people, taking a regular income is a good idea, opposed to taking the whole lump sum out. If you take out the whole thing, you've got to ask yourself, well, where are you going to put it instead? So if you're going to put it somewhere else, it needs to make sense and deliver a better return or be appropriate for you. Oh, this is my favorite question, Mike. What was the name of the podcast again? Where will it be released? So Checks and Balances on YouTube, Spotify, and Apple. We're really trying to grow it. We've got a couple thousand people listening to it a month, but we're all about improving financial education and financial literacy. So Checks and Balances, YouTube, Spotify, and Apple.
You should probably say it's check as in writing a check out to someone.
Oh yeah, CHEQUE.
Yeah.
Yeah.
Nice spelling.
Yeah.
There's a good source of property data. REINZ, the Real Estate Institute in New Zealand, publishes pretty good stuff. Homes.co.nz usually collates all of that data for you, so you don't have to do it yourself. And then, yeah, if you want to look at the raw data, you can get it from the Reserve Bank. They track most of it pretty closely, but yeah, REINZ is a pretty good source of data.
Cool. Where do you feel the balance lies between investing and paying down debt? Very good question. We literally just dropped a podcast on this last week. It does depend on your situation. When you are trying to invest money into, like, say, the share market, some people can get confused and go, oh, I'm making like an 8% return. This is really good. But if you're investing into the share market, you need to take off tax, and you also need to take off inflation. If you're paying like a 3% mortgage rate, you're saving that money straight away. With investing, you need to take off inflation because you're not spending the money right now. You plan to spend it in the future. So the investment needs to make sense from a net of tax and fees and inflation perspective. The other thing to keep in mind is our general approach, not for everybody, is buy your own home, investment property, and then do like an index fund. The reason why we like that kind of index fund in there as well is because all of your money is in property, you've got no diversification, and you've also got no liquidity of assets. So the index fund can be a good way to slowly build up over time. And our last one, unless somebody else put something else in, as a 29-year-old.
Questions in the chat, so we can jump on.
Okay, cool. All right, cool. As a 29-year-old with a first home and a 60 to 65% mortgage to value ratio, what would be your best investment strategy for the next 10 years, for example? Definitely come and talk to us. This is probably a bit too specific. Focus on paying down the debt and get debt-free ASAP. Continue regular mortgage repayments and use disposable income to invest elsewhere. Continue regular mortgage repayments, but leverage something other that's lucrative. And you also know me, Richard Cryer. I know Richard Cryer. It does depend on what you're trying to do. It depends on if the house you're living in at the moment is comfortable for your situation. You might be, depending on your situation, looking for something else. I would be, with that kind of equity, depending on your income, an investment property would potentially be a good next step. Once again, using the value of your home as security to leverage up and use the bank's money to turn essentially no investment to $100 million investment property. But depends on income, definitely. One of the big things with investment property is your ability to borrow.
Better to pay off the mortgage or invest. Going to come down to your situation again. How you want to invest, what you're investing in. You could make the case that having more mortgage and getting an investment property is better. But if you're just thinking about paying off your mortgage or investing in the stock market, James, you might want to chip in there. But to me, that's probably, you need to speak to someone about what's happening around you.
Yeah, simple question to ask, but a complicated answer.
Very loaded, yeah.
Yeah. Yeah, so probably come and have a chat.
So there's some more questions in the chat function. So what about, actually, I'll go into this, the next one first. So if you have an investment property and when we reach 65, is it best to sell and offload the property? Yeah, we talked about this, but this is going to depend on, is there mortgage on the property? What's the shape of your current property? What are your goals moving into retirement?
What other assets do you have?
Yeah, do you have other investments? Because it may be that you've got other investments and that this is a piece of your portfolio, there's no mortgage on it. So then I shouldn't just sell it now. I should sell it when I think I need to, and reasonably I'm going to get the best price for it, because you don't want to be forced into selling something just because we say sell it at age 65, you have to do it. So yeah, the other thing you just want to consider on that is the tax treatment of that property as well, and what that's going to do to your cash flow.
Yeah, if I can jump in there as well, Mike, I would be thinking about with your current investment structure, can you pay yourself an income of, say you want an income of $80,000 a year from retirement? If you can achieve that income with the investment property and you can do all the things you want to do, then that's great. You probably don't need to be thinking about selling it anytime soon. But if the answer is, I need the equity in that house in a liquid investment to pay myself an income and allow me to do the things that I should do, then you should consider whether that property is the right thing to hold in retirement.
Yeah. And then the question above it. So what about investing in metals, so gold and silver, or crypto, so Bitcoin?
Yeah. So golds and silvers aren't part of any investment strategy that I use. The reason for that is if you look at the performance of property and shares in comparison to gold, gold is a stable asset that moves a little bit. Sometimes when people get scared, they tend to move to it more. But I would generally, it wouldn't be something that I would recommend. I wouldn't include it in a strategy. Crypto, to be fair, it's something that I don't understand well enough and haven't invested the time to understand properly. I wouldn't be, solely dependent on crypto for your retirement. It really depends if you're going to invest into crypto, why are you investing into crypto? Has your good looking mate, Mike, just said, hey mate, you better buy some crypto. I'm going to the moon. Do you want to join me? And I'm like, well, of course I want to. Or do you believe in the fundamental changes of how we will be dealing with currency and the exchange of money in the future? And if that's the answer, then yes, it makes sense. If you've got no experience with it, but you want to learn, the best way to learn is to dabble a little bit of money regularly into it to start to understand it over time. But you've got to, crypto is like, if shares are a bouncy ride, if shares are a jumping castle, crypto's the scariest roller coaster you can go on to, because you just look at what Bitcoin's done over the last 6 months. I know it's a little bit long-winded, but probably my view.
Yeah, the other things just to consider there, if you are looking at crypto, is obviously just look at the amount of scam and theft that gets that happens in the space. So please just consider how you're storing your crypto. So it's on that cold storage as opposed to something that's online, and also what providers you're using for everything. Because you'll look, a lot of them get raided, a lot of those coins disappear, just that sort of stuff. And also remember that it does have transaction costs as well. So there's gas that you've got to pay. So yeah, you just need to be prepared that it could all go to zero at any point.
Yeah. While on the flip side with property, I know what property will do over 10-year periods. I know what the share market will do over 10-year periods. I just don't know what crypto will do over 10-year periods.
Yeah. Cool. I think that is pretty much all of the questions we've got.
Awesome. Okay, so we'll send out an email after this. Thank you for everybody who stayed far past the hour mark. Amazing turnout, great questions. Check us out on Checks and Balances and book a time if you'd like to have a one-on-one chat about your own situation so we can help you achieve financial freedom. Bye, everybody.
Cheers.